Welcome back again, and thanks for being here every day, week in and week out. If I am clear, please type 99. Are we together? Type 99. Let me hear you guys. Okay. Thank you. And let's show appreciation and thank him and welcome him for being here with us every day, every Thursday and every Friday. And let's type 33 and let's welcome Ustad Suleiman Ibrahim.
Thank you, Kev. Hello, guys and girls. I hope you're excited as I am. So I'll be sharing my screen so that we can continue with our technical classes. Okay. Waiting to share the screen. Allow screen share. Yes, thank you. So if you can see my screen and you can see both the chat and the PDF where there are notes written, please type 111 so that we can start. Okay, so today we'll be doing different. I've been revised the windows for the chat. So we'll be going through the theory part and then we'll be applying it on the chat. Okay. So today we'll be going through our 10th lesson, which will be indicators. And we have two types of indicators, leading and lagging. So the leading and lagging indicators. So what you need to know, technical traders use indicators to identify market patterns and trends. Most of these indicators fall into two categories, leading and lagging indicators. Discover some popular leading and lagging indicators and how to use them. So what is a leading technical indicator? A leading indicator is a tool designed to anticipate the future direction of a market in order to enable traders to predict market movements ahead of time. So this one is actually, it's ahead than the price, where the price is. Here is an illustration. We have this aqua pattern here as the leading, and then this one, the dark one is the actual price. You can see the leading has already curved for a downward. It was going upward, and then it had curved for a downward before the price even actually went for a curve for a downward. You can see where the price came down. That's where, when the leading indicator came down, as it was falling for a sell, that is where the price now caught up. So you can see here that it went for a bullish, the leading indicator went for a bullish, and then that's when the price came for a bullish. So now, can you guys hear me clearly? If you can hear me, type 22. Yes, okay. So in theory, if a leading indicator gives the correct signal, a trader can get in benefit in before the market movement and ride the entire trend. However, leading indicators are by no means 100% accurate, which is why they are often combined with other forms of technical analysis. So technical analysis, you know, is the drawing of the trend lines, support and resistance, analyzing the charts. And then you add an indicator so that you can actually know the proper direction of the market. What is a lagging indicator? A lagging indicator is a second type of indicator, which is a tool that provides delayed feedback, which means it gives a signal once the price movement has already passed or is in progress. These are used by traders to confirm the price trend before they enter a trade. So lagging indicators usually follow the price. The price actually moves faster, and then the lagging indicator comes next. You can see here our dark, in this illustration, we have the aqua as the lagging indicator, and then this one, the dark one, as our actual price. So when the price had reached this point and then it came for a downward, still our lagging indicator was going bullish when the price was going on a downward direction. It hadn't caught up because it is lagging. there's a difference in time. So yeah, these indicators are commonly used by trend traders. They don't show an upcoming price moves, but confirm that a trend is underway. This tends to give traders more confidence that they are correct in their assumptions rather than providing a specific trigger for entering the market. So we have the difference here before we actually get to the indicators themselves. So leading versus lagging technical indicators. What is the difference? The most obvious difference is that leading indicators predict market movement, while lagging indicators confirm trends that are already taking place. Both leading and lagging indicators have their own advantages and drawbacks. So it's crucial to familiarize yourself with how each works and decide which fits in with your strategy. Leading indicators react to prices quickly, which can be great for short-term traders, but makes them prone to giving out false signals. This happens when a signal indicates it's time to enter the market, but the trend promptly reverses. Conversely, lagging indicators are far slower to react, which means that traders will have more accuracy, but could be late in entering the market. Relying solely on the either could have negative effects on your strategy, which is why many traders will aim to find a balance of the two. So if you understood the difference between that we have, if you understood that we have two types of indicators, which is leading and lagging, and if you understood the differences, please give me 3 in the chat. Okay, thank you. So we have 4 popular leading indicators. Popular leading indicators are 4, which are, they include the RSI, known as the Relative Strength Index, the Stochastic Oscillator, Williams percent R, on balance volume or BV. So a lot of popular leading indicators fall into the categories of oscillators, as they can identify a possible trend reversal before it happens. However, not all leading indicators will use the same calculations. So there's a possibility that different indicators will show different signals. So let's dive into the indicators. This one is a leading indicator, we know therefore. So the first indicator we're going through is Relative Strength Index, popularly known as RSI. Is a momentum indicator which traders can use to identify whether a market is overbought or oversold. When the RSI gives a signal, it is believed that the market will reverse. This provides a leading sign that a trader should enter or exit a position. The RSI is an oscillator, so it is shown on a scale from 0 to 100. If the RSI is above 70, the market will often be thought of as overbought and appear as red on the chart below. And if the indicator falls below 30, the market is usually considered oversold and will appear in the green chart. So let's put our indicator, the RSI. Okay, we're going through both of them. So RSI, we come here to the indicators, Relative Strength Index. It's here. Click once and then close. Down here. So here we see we have a background here, which is purple. So we have an overbought and oversold. So we are told here that if the RSI is above 70, the market will often be thought as an overbought. No, where is 70? Big line, and then look for price at RSI 70 here. Put here, and then indicate with a color you can change as a here, red. And then this one here, look for 30. 30 here, indicate it as a green. So here, when the price moved, came to this place, you can see, let's bring our vertical lines, put it here, diagonal, put it here. So you can see when the price touched here at 30 level, there was no selling pressure. So the market started turning to be bullish. It went for a buy. It went up, and then it hit the 70 level, 70 level indicates it's an oversold, you see. So you can drag it here like this, here, and then drag this one, and then check for confirmation. You see, this one is a leading indicator. Yeah, it tells you like in the future what will happen. So the market came on our oversold, but here we are going bullish still, and then we reach at this point. Now that's the time when it hit the 70 again, and then oversold happened, and then the market overbought happened, and then buying pressure was not there, so sellers took over the market, and then the market came down, dropped, broke the 20, tested on it, broke again, became a resistance here, and then it broke through. When it broke through, you can see that when it came here to the 20 or the 30, so here, so this one is an oversold. Now there's no other selling pressure, so it started to turn bullish. So this one is telling you the market is going for a buy. Slowly the market started going up for a bullish, and then it reached here 70. Told you market has reached an oversold. So the market reaches an oversold, starts dropping. You see, how the RSI works. Okay, thank you. So this is an indication of the chart how it will work. So the next, so as mentioned, the danger with leading indicators is that they can provide premature or false signals. With the RSI, it is possible that the market will sustain overbought or oversold. The RSI is mostly used for oversold and overbought, and then you just indicate those 70, and because this shaded area like tells you this is the 30 and then this is the 70, look for overbought and oversold so that you can enter the market. So it is possible that the market will sustain overbought or oversold conditions for long periods of time without reversing. This makes it important to have suitable risk management measures in place, such as stops and limits. So we'll be going to the next indicator. So if you want to remove this indicator, what you do is you just bring a mouse here, and then you just click on remove. It's removed. The indicators usually fall down here, the leading ones. So stochastic oscillator is the second leading indicator. Another popular example of a leading indicator is the stochastic oscillator, which is used to compare recent closing prices to the previous trading range. The stochastic is based on the idea that market momentum changes direction much faster than volume or price. So it can be used to predict the direction of market movement. If the oscillator reaches a reading of 80 or over, the market will be considered overbought again, while anything under 70 will be thought of, under 20 will be thought as oversold. So let's come here, FX, where indicators and strategy are. Type stochastic, the first one, click once, then close. So the stochastic, telling you that you see the shaded area is where the ranges are 20 and then 80. 80 for an oversold and 20 for an overbought. Thought as an oversold. Yeah, 20 for an oversold and 80 for an overbought. So whenever it reaches 80, the market will be dropping for a sell. Whenever it reaches 20, the market will be going for a buy. That's why I was using the horizontal lines of red and green, so that just to know. So the direction of market movement, if the oscillator reaches a reading of 80 or over, the market will be considered overbought, while anything under 20 will be thought of as oversold. So let's bring our vertical line. Bring it here. Bring it here. So this one broke the 80 level, the price here. So when it broke, it came down. So here it's showing you that the market has reached overbought. So it will be dropping for a sell, but the price hasn't gone for a sell yet. Still, there's indecision candles. There are two candles still. So in the third candle is where the market now started dropping. These are leading indicators, so that's why it's actually ahead of the price. So the market came down, 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 and then it broke the 20 up to 0, and then there was no much selling pressure, so the market turned out to be a buy. And then it went for a buy, you can see. So the oscillator as well is shown as two lines on the chart. The percentage K, which is the black line on the chart below, this chart down here, and the percentage D, the red line. When these two lines crosses, it is seen as a leading signal that a change in market direction is approaching. Okay, when we come back here at this place, you can see there are two lines, the blue one and the red one. If you can see, the blue one and the red one. So here they crossed. When this cross happened, the market changed its trend of direction. It was going upward and then it changed to a downward, so dropping for a sell. So when these two crossed, it actually came for a sell, and then the cross happened down here, if you can see here, and then when the cross happened there, the market started changing its direction. You see, even the crosses actually help you, apart from the 20 and 80. So if you add all these plus your technicals, then you are good. So the market went here for a buy up, changed its direction for an upward trend. So if we've understood the stochastic, please type 33 in the chat. Okay, let's go ahead. So how do you remove? You just come here, remove. So okay, during volatile market conditions, the stochastic is prone to false signals. To prevent this impacting your trades, you could use the stochastic in conjunction with other indicators or use it as a filter for your trades rather than a trigger. This will mean entering the market on the trend is confirmed as you will with a lagging indicator. So, okay, the idea is sense. So next one will be the Williams percents R is the next leading indicator. The Williams percentage range, the percent range, more commonly known as the Williams percent R, is very similar to the stochastic. The main difference being that it works on a negative scale. The other one was working on a positive and negative, positive integers of 20 and 80, but this one is working on 20, negative 20, and negative 80. So the main difference is it works on negative scale, so it ranges between 0 and negative 100. And it uses negative 20 and negative 80 as the overbought and oversold. They are similar, but this one is on negative. So let's go here to our indicators and then type William. See here, the first one, click once, and then close. So it is. You have the ranges already shaded for you. It's a default. So it ranges between 0 and uses negative 20 as the overbought and negative 20 also. So the idea is still the same as the stochastic. So let's come here and try to see how it works. Okay. So here it broke and then came back to the 80 and then hit the 80 again, pulled back. So what happened is it indicated that now, since it hit the negative 20, it is going for a sell, dropped for a sell. And then it reached negative 100 and then came back to negative 80. And then the trend changed. The market reached an oversold, now here. Went for a buy, broke out the negative 20, again retested, and then reached another high here, which is here. Negative 1, negative 2, yeah. It reached an overbought and then started dropping for a sell. So use it for identifying whether it will be an overbought or an oversold by looking at the numbers. So if you've understood the Williams percent R, give me 4 in the chat. It's similar to the stochastic. Okay. So our next indicator will be, so there's some, the indicator is highly responsive, meaning it might start to move to highs or lows, even if the actual market price does not follow suit. As the Williams percent R is leading, these signals can be premature and less reliable than other entry signals, which is why some traders prefer to use negative 10 and negative 90 as more extreme price signals instead of using -20 and -80. So we will be moving to the next leading indicator, which is the OBV, known as on-balance volume. On-balance volume is another leading momentum-based indicator. It looks at volume to enable traders to make predictions about the market price. OBV is largely used in shares trading, as well as volume is well documented by stock exchanges. Okay, traders who use OBV as a leading indicator will focus on increases or decreases in volume without the equivalent changes in price. This is believed to be an indication that the price will increase or decrease. Okay, we'll come here and then type O, on balance volume. Close, it's down here. So here you're seeing -200, -250, negative all the way to -400. So this one is actually giving you like the volume, but it's most popularly used for stock exchanges. So here, you know, it's an oversold, like here, an overbought, rather, and then it started dropping for an oversold. The numbers are just different, but the idea is the same, how they work. See, dropped for a sell. An overbought happened. So if you understood the OBV, give me 6 in the chart. They all work like similarly. They work the same. 6. Yeah. We are through with our as a leading indicator. OBV is prone to giving false signals, especially as the indicator can be thrown off by huge spikes in volume around announcement that surprise the market, such as news. News is a component that like surprise the market. Although volume changes, this is not always indicative of a trend and can cause traders to open positions prematurely. As with other leading indicators, the OBV is often used in conjunction with lagging indicators and a thorough risk management strategy. So now that was our leading indicators. Now let's go and look at the 3 popular lagging indicators. Lagging indicators, we know they come before after the price, but leading indicators, they come before the price. So popular leading indicators, lagging indicators rather, include the moving averages, the MACD indicator, and the Bollinger Bands. Lagging indicators are primarily used to filter out the noise from short-term market movement and confirm long-term trends. They are usually drawn onto the price chart itself, unlike leading indicators, which usually appear in separate windows. You see, leading indicators comes down here. The indicator is down here, but for lagging, it will come to the charts. So let's remove this. Someone is asking which is better, leading and lagging. It's better to use the lagging. I prefer that one. And it's as well, you don't use only the indicators, but you can also add your analysis, your technicals. So adding both of them can make you a successful trader. Okay. So the first one is moving averages. Moving averages, MS, are categorized as a lagging indicator because they are based on historical data. Buy and sell signals are generated when the price line crosses the MA or when 2 MA lines cross each other. So let's come here. This is where you will because of strategy. So we'll type moving averages. Right? Moving average. This one. So we have this one. This one is a 9 moving average. You'll just come here, click on settings, input the length of the moving average that you want, and then the style. You can just come here, change the color of that you want, and then you can change the thickness as well from here. Coming down here, and then just click here and then say okay, it's changed. So this one is the 9. 9 is actually, it works as a trend line because it follows the price. Whenever the price goes down, it goes down with the price. When the price goes up, it follows the price up. So let's use rather a different one and use the 50. The popularly used lagging indicator. So here, you see it's different. So 50, however, because the moving average is calculated using previous price points, the current market price will be ahead of the MA. So you see here, the MA is still coming on a consolidation form, but the price has already gone down. So it's still catching up. Now, that's when the price has already gone down well. That is when the moving average started going down. And the 50 MA usually comes the last 50 candles. If it's 1 hour, yeah. So in the below 50-day MA example, the moving average has crossed the price from above, indicating that an upward reversal is imminent. However, we can see that MA is slower to pick up the bullish trend. Come here. You see the market was already going for a bullish. Down here, it came for a bullish, up. You can see it was going up. It didn't catch up with the bullish, but it caught up with them when the market was coming down. That's when it caught up. It's lagging, it's behind the price. So if you want to use like two indicators like here, when two, or this is only a single moving average, or when two MA lines cross each other, this is when you're using like two moving averages to analyze. So if you want to add another moving average, you'll just come here, type moving average, then close. So you have this one, the 9. The 9 works as a trend line, I told you. So if you want to use the popular one, like the MA cross of 50 and plus 4, as the gold cap works. So here it is. So when these moving averages, they cross here, the same when two lines cross each other. So when a cross happens, let me change the color. Okay, green. Okay. Okay. So whenever a cross happens, you see, when a cross happens, it actually gives you an idea telling you that the market has changed its direction. The market was going for a down, and then cross happened, but this one still continued. Then it came up, another cross happened. So you know this is the direction, and then you just look at the first two candles, and then with your technicals added, you know these are, it will be like going for a bullish. So most of the traders, when they're using the MA4 and plus 5, 50 plus 4, they usually use it as an analysis to analyze the markets. So if you're together on the moving average, give me 3 in the chart. Okay. So if you want to remove, you just click on it and remove. So the moving in the below 50-day MA example, the moving average has crossed the price from above, indicating an upward reversal is imminent. However, you can see that the MA is lower to pick the bullish trend, as you've seen, when it does occur. Okay, this is an illustration on the diagram where the price was falling. It came with it, but when it was going up. It dragged a little bit. That's when it's followed when the price was coming down. You see, it's always the MA is always behind the price. Okay, moving averages can be calculated over a time frame depending on the trader's goals, but the longer the time frame, the longer the lag. So, a moving average of 300 days will have a far longer delay than a moving average of 50 days. It is possible for lagging indicators to give off false signals as well, but it is less likely as they are slower to react. So the next indicator will be the MACD. MACD indicator, our second lagging indicator. Moving averages can be used on their own, or they can be the basis of other technical indicators, such as the moving average. Which one? Convergence, divergence, MACD. As it is based on MAs, the MACD is inherently a trend following or lagging indicator. However, it has been argued that different components of the MACD provide traders with different opportunities. Okay, let's go and bring down our MACD. MACD here. Click once and then close. The MACD will come down. Okay. So there are 3 components to the tool, the MACD here. 2 moving averages here. This one here, this blue line, and this yellow or goldish line. Yeah. The 2 moving averages, and two moving averages, and a histogram. The histogram is this one. You can see the bar candles here, the blue ones, and the red ones here. This one is the histogram. So the two moving averages, the signal line and the MACD line, are invariably lagging indicators, as they only provide signals once the two lines have crossed each other, by which time the trend is already in motion. Okay, so what are they telling us? So here we have a MACD, we have the 12, 26, and the 9, which is the moving average. So we also have a histogram, and then by which the trend is, but the MACD histogram is sometimes considered a leading indicator, as it is used to anticipate the signal crossovers in between the two moving averages. This one is actually how they work. Yeah, whatever I'm reading is how they work. The bars on the histogram represents the difference between the two images, the difference in space. As the bars move farther away from the central zero line, our central zero line is this one here. This one here. Okay, this is our central zero line. So it means that the moving averages are moving as the bars move farther away from our central line. Let me change the colors of the mixer. Okay. So you can see the bars are going up, 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 up. Meaning, if you see this blue line and this goldish line, there is a difference in between their space. They are farther apart, and then the bars still go increasing. And then when these two like come together, they cross. When they make a cross, then the bars start going down, meaning that they are close together. So it means that the moving averages are farther apart. Once this expansion is over, a hump appears. This one that looks like a hill, this top one. A hump appears on the histogram, which is a sign the MAs will tighten. So the hump appeared, and then the MAs, they came together as they crossed, and then they slowly came together. The space is reduced, and then the hump started going down, which is a sign that the MAs will tighten again and a crossover will occur. Although the histograms can be used to enter positions ahead of the crossovers, in the moving averages inherently fall behind the market price. So let's try to analyze this one by bringing down our vertical line so I can see clearly. Okay. So here we had the histogram telling us the bars increases, the hump telling us a cross is about to happen, and then the cross happened. What are we seeing here? That with the 9, it's when the 9 comes down, it's telling us this market is going for a sell, because there's a trend that is about to happen. A trend has happened for a sell. The market reached an overbought and it's going for a sell. So the sell happened here because it's a lagging indicator, it's behind them. So here, another hump was happening because this bars was increasing for the sell, and then the two lines crossed each other. And then when the hump is reducing, you know, a crossover is about to happen. What happens? The direction of the market changes. The market was coming for a downtrend, and then when the cross happened, the market is going for an uptrend. You can actually see. These are a strategy that you can use with your technicals combined. So the market changed for a bullish trend. So if we are together on the MACDs, please give me 5-5. MACDs, have you understood the MACDs? Yes. Okay, together there. So how do you remove? Just click here. Although the histogram can be used to enter positions ahead of the crossover, the moving averages inherently fall behind the market price. So in general, it is a lagging indicator. This means that there are instances where the market price may reach a reversal point before the signal has even been generated, which will be deemed a false signal. So that's about the MACDs. And then our third lagging indicator is the Bollinger Bands. The Bollinger Band tool is a lagging indicator as it is based on a 20-day simple moving average and two outer lines. So how does it look like? This Bollinger Bands. These are the bands, the outer band and this outer band. And then we have this line in between, this moving average in between, which is on a day simple moving, a 20-day simple moving average, and two outer lines. And then the candles are within the bands. And then the line is crossing within the band. Okay, how does it work? These outer bands represent the positive and the negative standard deviations away from the SMA and are used as a measure of volatility. When levels of volatility increases, the bands will widen. So when volatility is increasing, is like this market here was going for a drop, a downtrend. So you can see the bands are this outer one and this outer one, there's an expansion in between. And then when you see here there's a volatility, the market is going for an uptrend, came up, so there's an expansion between the bands here and here. So when the market was dropping again for a sell with high volatility, you can see that the two outer bands, there is a big space in between. Okay, now we have understood that. And will widen, and as the volatility increases, as the volatility decreases, they will contract. So when are they contracting here? There's no volatility, it's going slowly. You can see the two outer bands are close. There's no widening between them. They are contracting. And then again here, there's no volatility. There's a lot of indecision happening here. It's rather you don't enter the market from here. So here, there's a contraction between the two lines, the two outer lines, the bands. So when the price reaches the outer bands of the Bollinger, it often acts as a trigger for the market to rebound back towards the central 20 period moving average. So like here, the price was coming down, it hit the outer band. When it hit the outer band, the price went up to the central 20 period moving average here. This line, 20 up to here. So the price went up, and then broke through the band, and then came back, and then the price dropped to the 20. So the price will always respect the 20 SMA. Again here you see the price came down, touched, went back to the 20 SMA, and then crossed, and went up, touched the outer band, consolidated for a long period of time, and then dropped, touched the 20 SMA. So it usually respects the bands and the 20 SMA. So if you are together, and by the way, when the bands are moving up, when the bands are going up, as you can see, when the bands are up and the 20 SMA is up, is an uptrend. So when they are coming down, again, is a downtrend. So when they are kind of like flat, these are an indecision. So it's not you enter the market from here. Always try to avoid market in a consolidation state. Okay, if you have understood the Bollinger Bands, give me 66 in the chat. Yes, thank you, 66. Okay, now here's chart. So there are strategies that suggest the bands will have leading indicator properties, but alone they do not give out leading trading signals. Bollinger Bands can give no indication of exactly when the change in volatility might take place or which direction the price will move in. So if you want like basically to watch out for volatilities, try to use the Forex Factory from use or other news websites that you prefer, so that you don't get caught up when news is about to happen. So these white traders will often confirm the Bollinger Band signals with price action or use the indicator in conjunction with other lagging or leading indicators such as the RSI. So here it's all we are done with the lagging and the leading, the popular ones. So here it's leading and lagging indicators, all of them summed up together. So a leading indicator is a tool designed to anticipate the future direction of a market. Yes. A lagging indicator is a tool that gives signal once the price movement has already started. Yes. This one lagging follows the price, Leading is ahead of the price. Leading indicators react to prices quickly, but this makes them prone to giving out false signals. No one knows the market 100%. So if you follow these leading indicators fully 100% without other technicals, then you might get a false signal and lose that trade. So lagging indicators can be more accurate because they are far slower to react. So this one is most suitable because you can actually use it with the technicals and then understand like the direction of the market without being given a future signal where the market goes. So a lot of popular leading indicators fall into the category of we've seen oscillators, including the RSI, stochastic, Williams percent R, and the on-balance volume. Lagging indicators are drawn onto the price chart itself, like this one is drawn on the price chart, the Bollinger, which is a lagging, are drawn onto the price chart itself and include moving averages, the MACD, and the Bollinger. The only lagging indicator that will come down here as the leading indicators is the MACD, because it contains the histogram and averages with it. So relying solely on either could have negative effects on a strategy, which is why many traders will aim to find a balance of the two. So that was all of it. I guess there are no questions, and that was the end of our session. So guys and girls, thank you for attending the session. So this is our last session for today. Until next time, have a good day.
Inshallah, inshallah. Thank you, Ustad. Thank you, everyone. And stay safe, inshallah. See you soon. We out.